Hi, welcome to the Fall 2025 It's Your Money and It's Your Estate workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Let's start the program. This webinar is the 4th session of the It's Your Estate workshop series. The topic for today is Strong Retirement Asset Planning. Our moderator is Peter Kote. Our guest speaker is Michael Simon. And this webinar is brought to you by the Segestrom Center for the Arts. Enjoy the workshop.
Good morning, everyone. This is Financial and Estate Literacy. Today, we're going to have retirement planning as one of our sessions, one of our 6-week programs on estate planning. And we have an outstanding presenter today by the name of Michael Simon. And Michael, what's unique about you is that you spend an enormous amount of time with individuals who have retirement assets in their 401k, 403b, and the reason why most attorneys don't spend the time on this area is because there's no documents really to complete. And we're going to get into this in a little bit, but I want you to put up your Ask First form just for a few minutes and just to show people that it's there. And
Absolutely.
and we got that.
All right.
Yeah, there it is. Go ahead and take it off, and I'll stop sharing. And we're just going to go through it verbally.
Okay.
And so, Michael, how long have you been in the practice of estate planning?
Well, in just a few months, I'll be going out to dinner for my 25th anniversary of being an attorney. So, it has all been in estate planning.
Uh, do you do any other practice in any other areas of law?
No, I don't. And to everyone in the participants, that's really important because this area is complex, and you don't want your estate planning attorney also doing divorces on the side. There's a lot of complexity in the area of estate and tax law, and so when you're shopping for an estate planning attorney, make sure that that is his or her primary focus.
Yes. You just practice in California. You're licensed by the bar.
That's
Uh,
correct.
how do you charge your clients?
Well, because I'm an attorney, I have to give you the long answer.
Okay.
So, before I talk about how I charge, I do want to say that, this really isn't an area for you to budget price shop. This is a really important area, documents that are going to be used in emergencies and so forth. And so, my first point before I talk about pricing is that you may not want the cheapest estate planning attorney because you may get what you pay for. The second point I want to make is that make sure you're comparing apples to apples. And what I mean by that is you might make a phone call and find out that an attorney charges $1,000 for a trust. But don't forget, it's not just that a trust is all that you need. You also need the will, the power of attorney, healthcare directives, notarizations, deeds, and we might find out that it really isn't $1,000. So make sure you're comparing apples to apples. Now, with that said, we charge in two different ways at our firm. The first way is a fixed rate or a flat fee, and the second way is by the hour. Now, for our flat fee pricing, we try to pack a lot of value into the pricing. So, of course, we do your will, your trust, your power of attorney, and your healthcare directive, but we also help you and file the deed for your primary residence. And as Pete was just mentioning, we also spend a lot of time helping you with your beneficiary designations on these retirement accounts. And you'll see after today's presentation how important that really is. But in addition to that, we like to spend a lot of time with our clients. So I personally meet with you for 90 minutes or 2 hours to help you design a customized estate plan. And then when it's time to sign your estate planning, instead of cutting a corner and just mailing something to you, I have you come back to the office. I supervise the signing. I go through the documents with you because we want to make sure they're executed correctly and they're available when you need them. So yes, this all takes a lot of extra time, but again, we're not trying to cut corners. We're trying to give you the best value we can. So with all that said, for a married couple, our average price is about $3,900 to $4,500. For a single individual, it's about $2,900 to $3,500. Now, with that, go ahead.
No. Uh, do you offer a kind of an initial consultation at no charge?
That's right. I'm happy to spend 15, 20 minutes with a client at no charge. We can talk about their existing trust, or if you don't have an estate plan, we can go through the process. But I do want to add one last thing is that we also charge by the hour, as I mentioned. And those are cases where we have, I'm going to say, a non-traditional or a more complex situation. Maybe we have a very large estate where we have to plan for estate taxes. Maybe we're disinheriting a child, or we have a blended family where there's a high level of complication. And in those situations where we have the complicated situation, we charge by the hour, and my hourly rate is $525 an hour, and the paralegal's $175.
Yeah. And so do you provide your clients during the process when you're putting together the estate plan? Um, uh, are there any additional charges on top of that as far as deed preparation, an assignment, or anything else in relation to that?
So when we do the flat fee pricing and we sign a fee agreement after our initial meeting, then everything is included: notarizations, attorney times, deeds, recording fees, everything.
Great. Okay. Again, I want to remind everybody that you're welcome to chat amongst each other as to comments, and Don will kind of glance at that. But if you have a particular question, as Michael will like to say, he can't charge you because we're on a we're on a webinar. So this is a good time to get those questions in and use the Q&A. Michael, why don't you go ahead and bring up your presentation? Does one of the questions is regarding fees, Michael? Do you include the notarization in the charge, or is that an extra?
No, in the flat fee pricing, everything is included. No extra charge for phone calls, notarizations, photocopies, binders, all that kind of stuff is all included.
Yeah, we love it. Okay, let's get going on the presentation.
All right. Well, before I begin, I do want to say I'm excited to be here. I have a great presentation for you, packed with a lot of really useful information. I think everybody's going to get something out of the presentation today. And also, as we'll talk about, this is a place or an area where the law has changed significantly over the last few years. So we want to make sure that you're up to date on all of these new laws. So
And by the
with
way,
that said,
this what most attorneys are not. Even estate planning attorneys are not, because this is a very complicated area.
it is a complicated area. So let's talk about what we're going to learn today. And so I have a slide here where we are going to talk about what the latest rules for these retirement accounts. And as I just mentioned, we do have a lot of changes. Many of you may have heard of the Secure Act, and that came out in 2019. And then we had Secure Act 2.0, as well as a number of IRS notices. And then a little over a year ago, we had several hundred pages about the Secure Act in the final regulations. And so all of this is really new and changed a lot of the planning in this area. In addition, we are also going to look at how we calculate your required minimum distributions. We call those RMDs. Now, on the RMDs, if you don't know what an RMD is or how to calculate it, then perfect, you're in the right place, because I'm going to show you how to calculate your RMD today. We're also going to spend some time about talking about the options to choosing beneficiaries for these retirement accounts and how we fill out those beneficiary designation forms, which I'll explain to you in just a few minutes. We'll also discuss whether the Stretch is dead or alive. And if you don't know if Mr. Stretch is dead or alive, then no problem. We've got you covered. I'm going to explain it to you. And then the last part of the presentation is going to be about Roth IRAs, and they do have a different set of rules, so I've saved them for the end.
At this point, I'm going to interrupt you because I'm going to say, listen, here's what we're going to do. I'm going to launch a poll to ask people about their beneficiary designations. So if you don't see this, move your mouse around or do something because then it'll pop up. Have you designated beneficiaries for your retirement accounts? And it's multiple choice, so you can say yes and no, and I don't know. Yes, no, and I think so because you aren't certain yet. So if you want to go through and do that, then I will let you answer the questions and let Michael think as he's bouncing around there in terms of what he's doing.
You want me to
So
keep going or hold off for the...
you can keep going and make an answer, and then I'll interrupt you again and pop up the results for them.
Okay. Well, before I get into some of the substantive material, I want to talk about a little bit about vocabulary. So, when I say retirement account this morning as we go through this presentation, I want you to know what I'm talking about. And I'm talking about your IRA accounts, your 401ks, your 403bs, your 457s, pensions, KEOs, all those things. So, think when I say retirement account, think your IRA or 401k. Again, there are different rules for the Roth IRAs, so I'll save them till the end. Now, why do we care about these retirement accounts? Again, your 401ks and IRAs and so forth. And the first reason is that contributions we make to these accounts get an immediate tax benefit. And what I mean by that is that the amount you put in there is not subject to tax. So let's say you have $100,000 worth of income and then you decide to put $5,000 into a contributory IRA account, the $5,000 doesn't get taxed and you only have taxable income of $95,000. So again, we have this immediate tax benefit. But more importantly, the money, the contributions that we put into these retirement accounts start to grow tax deferred, meaning that we don't have immediate income tax every year and capital gains tax on these monies in these accounts. So there is an amazing potential for significant compounding where the money grows faster in these tax deferred accounts than in a taxable account. Now, I know Don and Pete are offline, but I usually ask about how much money do you think are in these retirement accounts? Sometimes I hear people say billions, but it is $43 trillion in retirement accounts as of 2025. So my question to all of you is, what about Uncle Sam?
However, Michael, let me just interrupt you. I want to share this just as a note for you. With that many trillions of dollars, some of you acknowledge you really haven't done your beneficiary statements and you're not sure if you have them. So that's where this becomes really important to us in terms of what's there. So just as a note.
Great feedback. So with that in mind, this money that's in these retirement accounts, these trillions of dollars, remember, you didn't pay tax when the money went in. All the growth inside the account has also not been taxed. So my question to all of you out there is, do you think that the IRS wants a piece of this action? And of course, the answer is yes, they do want to tax this money. And what about when you pass away? Is the IRS going to come after these retirement accounts to collect money from beneficiaries or tax from beneficiaries? And the answer is yes. In fact, under the Secure Act, as I will explain shortly, the IRS is going to get their money from our beneficiaries faster than we ever expected. And what I want to say here in this slide is it's important as you think about these retirement accounts to keep in mind that this money is not tax free. It is only tax deferred, meaning that someone, generally, there are some exceptions, but someone is going to pay the tax on this money one way or the other. Some people say the IRS has a mortgage on these accounts. And if you look at your $500,000 IRA, you should see the number 250,000 because the IRS gets half of it. Now, the last slide that I want to talk about before we get into the substantive material, and Peter has already referenced this, is that this area is a really important part of estate planning, but it is sometimes overlooked in the estate planning process. People get focused on doing their trust and their wills and their powers of attorney and healthcare directives, and they forget about their retirement accounts. I see it all the time. I think doing your beneficiary designations for retirement accounts as well as insurance is sort of the fifth pillar of a good estate plan. And the takeaway for the slide is when you do your estate plan, or if you've already done your estate plan, make sure you take care of the fifth pillar in dealing with these beneficiary designations, as we will talk about in just a minute. So the first part of my presentation is how do we treat these retirement accounts during your lifetime while you are alive and you are still the owner of these accounts? And the first rule that I want to talk about is what happens if you want to withdraw money from these accounts, but you are not 59 and a half years old? You are, in other words, younger than 59 and a half. Well, unfortunately, there's something called an early withdrawal penalty. And that early withdrawal penalty is 10% federal and 2.5% California. So a cumulative amount of 12.5%. But keep in mind that no income tax has been paid on this money. So it is not just the 12.5% penalty, it is also our regular taxes. So for example, maybe there's a 30% federal tax rate, excuse me, or maybe there's and in addition a 10% California tax rate. If that's the case, we'd have 40% in regular taxes, and then we add the 12.5%. So it can be a very expensive endeavor to withdraw money before 59 and a half. Now, when you do withdraw money from these accounts, you get something called a 1099-R, and then you report that money on your tax return. And again, if under 59 and a half, apply the additional penalty. There is good news that there are many exceptions to the penalty. Many were in existence, but the Secure Act added a number of penalty exceptions. I think there's something like 20 or 30 exceptions to this 12.5% penalty. But recently they added some other more interesting penalty exceptions, and those include victims of domestic violence, waiver of penalty for people who are terminally ill. If we're spending this money on qualified long-term care expenses, there are exceptions for all of those things. So the important takeaway really here is that before you pay the 12.5% penalty, check through all of these exceptions to see if you don't meet one of them. Now, when you turn 59 and a half, but you are not the age of 73, and that isn't a typo, it is not 70 and a half or 72 anymore, you may, but you are not required to make withdrawals from these retirement accounts. Again, it's just an option. Because we're over 59 and a half, we are not subject to the early withdrawal penalty. But remember, this money hasn't been taxed. When you withdraw money during this period of time, you still get a 1099-R, and that money has to be reported on your tax return. Where it starts to get, I'll say, interesting is when you turn 73. And again, not 70 and a half or 72. And as a little bit of a sidebar, as you may all know, there was for decades this rule of the age 70 and a half was our key number. Then they changed it to 72. And under the new Secure Act 2.0, they've moved the required date for you to start taking distributions from these accounts to age 73, and it's going to creep all the way up to age 75 in 2033. But for now, our rule is age 73. And so when you turn 73, it is time that you have to start your required minimum distributions. Again, what we call the RMD. No penalty, as you already have learned, because we're over 59 and a half, but it is still subject to taxes. And I'm going to explain how we do our RMD calculation in just a second, but I do want to point out this point here, the last one on this slide here, is that to understand why there are RMDs and how all this works is just basically to understand that the IRS is simply saying, hey, we've given you a tax break long enough. We've let you defer all the income tax on all of these monies. You're now 73 years old, and the IRS says it is our turn. And what they mean by that is starting at 73, they want you to take a little bit out of the account for one reason and one reason only. We want the tax. And so that is what all of this is about, is tax collection for the IRS. Now, as we've just talked about, although there are some very limited exceptions, we all have to start doing our RMDs when we turn 73. And generally, you have to complete your RMD before December 31st of each year. However, as always, there are exceptions, and the main exception is what we call the first year rule. And the first year rule says that if you want to, you can delay your first year distribution, the year you turn 73, until April 1st of the following year. But be careful here, everyone. This sometimes can be a tax trap because what we will be doing is pushing our first year distribution into our second year, which will cause two distributions in that second year. So let's assume I turn 73 this year and I decide that I want to delay my distribution using this first year rule until 2026. Well, that's fine, except that I still have to do my 2026 distribution, which means I'm going to have my 25 and 26 distribution all in the same tax year. And we call that bunching of income. We will increase our taxation possibly in 2026. In my example, could cause higher taxation of Social Security, move you into a higher tax bracket. So make sure that you take a look at this rule, if in most cases, my clients, it doesn't make sense to bunch the income. They do their first year distribution in the year they turn 73. Now, a couple other points about required minimum distributions. The first is I'm going to show you how you take out the minimum, but you don't always have to take out the minimum. You can take out more, but unfortunately, it doesn't provide us with any credit for future years. So if there's a required minimum distribution of $5,000 and you decide to take out 10 that year, the extra $5,000 doesn't carry forward and give you any credit. We do have to recalculate the next year, not factoring in the prior year distributions. The other thing I want to mention before I show the calculation is let you know how serious the IRS is about this. Under the previous rules, there was a 50% penalty. That's 50. Under the Secure Act 2.0 that was recently passed, they decreased that to 25%, which is still pretty serious, and 10% if you correct the mistake in a timely manner. So the takeaway here really is that they're pretty serious about you doing this correctly. Now, as far as calculating this required minimum distributions, most banks and brokerage firms do this calculation for you. And in the year you turn 73, you basically will get a letter from your bank, your brokerage firm, your employer, and they will do a calculation for you with what they believe to be your RMD. Now, you can do this calculation yourself using an IRS table, which I've provided for you, and I'll provide more information in just a minute. And we do have to recalculate this required minimum distribution every single year to come up with the proper number. So let me show you how it works. And I have to tell you, it's really quite simple. All you do is take the prior year balance of your retirement account on December 31st of the prior year. We use again this table, which gives us a divisor, and we divide those two numbers together, and that's it. That gives us our RMD, or required minimum distribution. So this table, which is what we call a uniform table, and I'm going to talk a little bit more about it in just a second, gives us these divisors, and this is available from the IRS, and I'll show you where in just a minute. But I'm going to give you an example. Let's say I turn 73 this year. When you go to the table, it says that 26.5 is my divisor. And I'm going to give you an example. Let's assume I have an IRA account that has a balance last year of $100,000 on December 31st. I went to the table, I'm 73, I got my 26.5, and I am able then to do the calculation. Oops, hang on a second. Oops. Hold on, a little technical difficulty. Hang on. You guys, I'm gonna have to reshare my screen, so just give me 1 second. All right. Sorry about that. So with that division or the dividing those two numbers together, we get $3,773 as our RMD. Now, with that in mind, what I've taken is a little bit more of um, uh, the uniform table, and I have added another column here, which takes the divisor the IRS provides and provides it, displays it as a percentage. So, for example, if we look at age 26, a divisor of 26.5 for someone who's 73 years old, that converts to a 3.78% withdrawal. In other words, that's all the IRS is asking us to withdraw in the year we turn 73. And you can see that's a pretty low number, somewhat generous in my opinion. Back in 2002, where we had a different set of tables, the percentage requirement was much, much higher. In fact, if we jump over here till age 80, you can see our divisor is 20.2, and that converts to 4.96%. So something less than 5% is all the IRS is asking us to withdraw at the age of 80. And you could be having a good year, and perhaps your portfolio or income is greater than 5%. So you can still do your required minimum distribution and perhaps have more in the account than you started with. So pretty generous. Now, this isn't a secret, but this divisor is really your life expectancy. This is how long the IRS thinks you're going to live. And you can see if you make it all the way to 100, you still have 6.4 more years to live. Now, a couple of the things about the RMDs and these tables. Now, I've been talking about what we call the uniform table, and almost all of us use this same uniform table, the one that's reproduced in my handout here. And there are one major exception, and that is that if you have a spouse that is more than 10 years younger than you, then there is another table that you can use. But again, most of us, if we don't fall into that exception, fall under this uniform table. Now, there are new tables. There were some minor changes in 2022. So if you're going to go on the internet, etc., make sure you're looking at the 1/1/2022 tables to do your calculation. You can access the IRS publication 590B, again, the updated one after 2022, and it has all the tables that you need, including the uniform tables. So that's the way that you can access them. Now, one rule that I want to talk about for these retirement accounts is that if you have more than one IRA, the IRS provides a handy rule for us. And that rule is, is that you can take out all of your distributions out of one IRA account if you wanted to. So let me give you an example. Let's say you have two IRA accounts, and one is filled with stocks and investments, and the other is filled with cash. If you calculate your RMD in both those accounts and combine them, you could withdraw it out of the account that has the cash in it and satisfy the RMD for both accounts. This rule can be handy because then we don't have to disturb investments in the other account and we can satisfy our RMDs. The only catch to this rule is that it only works for IRAs. If we have multiple 401ks or 403bs, then it doesn't work that way, and we can only use this rule for IRAs. Yeah.
Michael, question for you. All of that was interesting, but I have no idea what it means. Is there any place that I could find out how much I owe from what I already have? For instance, if I got a statement from a brokerage firm, are they now required to put that on their brokerage statement?
What do you mean by owe?
So how much money do I have to pay? So if I want to try to calculate my RMD, I can go through the process you just gave us, and it was very thorough. But I believe if I also look at my investment statement, so my Schwab statement or Fidelity or my, Merrill Lynch or somebody else, buried in that form, there will be a thing that says you owe this much RMD on this account. And if you start taking it out as a QCD or something else, it will report. So they will tell you at the beginning of the year how much you would owe during that year and if you've taken any out. And all the statements I've seen have that buried somewhere in the form.
Okay, thanks for putting
Just as a note.
Okay. Um, speaking of qualified charitable distributions, that's what we want to talk about next. So that ends our discussion about the required minimum distributions. But I do want to talk about another possibility, something we call the qualified charitable distribution. And for some of you who have been participating in these, you may have heard of this already. We sometimes abbreviate it as the QCD. And basically, it allows taxpayers to distribute money from their IRAs directly to charities and exclude that money from their tax return. Now, this qualified charitable distribution rule is now permanent. There was quite a long history of it being repealed and moved around, etc., and then reinstated back in the law, but is now a permanent part of the tax code, as permanent as our tax code can be. And as you'll see in just a minute, I think more consideration should be given to this strategy under our current tax law, and I'll explain why in just a second. So I think the best way for you to understand how the qualified charitable distribution rule works is to understand, oops, I think I went too far, is to understand how this worked without the qualified charitable distribution rule. So before this rule helped us, what would happen is you would want to make a gift to charity. So you would withdraw money from your IRA. You would take that money, deposit into your checking account, and because you received the distribution, you'd have to add that income to your tax return in something we call your adjusted gross income. And then the hope was that you would get a charitable deduction to hopefully offset the income that you had to record. Now, this caused a number of issues. The first issue is that many of the taxpayers didn't get a corresponding charitable deduction. And that is, as many of you know, there are two ways that people file their tax returns. One is by itemization, where you get a deduction, and one is by a standard deduction, where you no longer get to take individual charitable deductions. So our clients, under the old rules, who were taking standard deductions would have to count the income and get no corresponding charitable deduction. And the reason this is more important now is that under the current tax law, they have increased our standard deduction, which has caused the effect of many people not itemizing anymore. So it is really important to look at this rule now because, again, no charitable deductions if we are taking the standard deduction. But without this rule, it caused other problems. Even if we got the deduction, it might increase the cost or tax on Social Security, Medicare, and other deductions. So it didn't work very well. And so to the rescue was the qualified charitable distribution rule that solved all the problems that we just discussed on the previous slide. When you use this qualified charitable distribution rule, the distribution is excluded from your income. So all the problems are solved. We don't have to worry about charitable deductions, etc., because the income doesn't count as taxable income on your tax return. And get this, the distribution counts towards your required minimum distribution, even though it is not subject to taxation. So let's think about that for a second. Let's say you did want to make a gift to the Seagertram Center, and you're going to write a check at the end of the year for $1,000 for a donation. Okay, why write it out of your checking account? Why don't we just take it out of your IRA account, have it sent over there? The $1,000 gets excluded as income from your tax return. In addition to that, the distribution will either satisfy or partially satisfy your RMD. So a pretty neat deal that I think a lot of people need to pay a little more attention to. Now, the rules. So for these charitable distributions, the limit, the most you can do in any single year is $108,000. The good news is that this is indexed to inflation, so the number is going up. You do have to be 70 and a half years old, and that isn't a typo. I think they made a mistake in the law here, but the bottom line is you've got to be 70 and a half to use this rule. The distributions do have to be made directly to the charity. Now, that doesn't mean that Schwab or Fidelity or Merrill Lynch couldn't make the check out to your charity and hand it to you, but it does have to be made out directly to the charity. And we do have some clients report that if we just have the brokerage firm or the bank send it out randomly, then the charity who receives it doesn't know who it comes from. So keep that in mind. You may want to let your charity know if it's coming directly from an institution that it's coming from you.
The other suggestion that I have for people is you tell them you tell the brokerage firm, write these checks to these locations, but mail them to me.
Yes.
I make a photocopy of them. And now that I have a photocopy, then I mail it with a note that said, hi, this is a gift. This is what I'm giving you. And therefore they know that it's coming from you and you have a record that they were in fact paid.
Good plan. The last point on these qualified charitable distributions is that there are some new rules about what we call split interest entities. And basically, what the Secure Act now provides is that we can do a qualified charitable distribution out of your IRA account and perhaps use a charitable remainder trust, or maybe even more likely, a charitable gift annuity, where in essence, you're able to give the money to a charity and then receive an income stream back on that charity, from the charity. Now, there is a limit currently of $54,000. That's the maximum amount we can do for one of these split interests. But in an interesting technique, Pete, I don't know if you're there. Didn't you say you recently had someone do this?
Um, yes, Michael. And the wonderful thing about it is that they removed the $54,000 from their IRA account, and they are earning close to 8% from the charitable gift annuity for the rest of their life, which is taxable, but they met the required minimum distribution, and they're making a wonderful gift to charity at the end of their life.
Nice. Okay, with that, that completes the first part of the presentation. Again, rules during life. And now what we want to talk about is rules after you pass away for these accounts and how we choose beneficiaries for these accounts. And I know you're all at home, or maybe you're in a coffee shop, but this would be the time for us to have a shot of espresso, because they don't make it easy. The IRS has made this area very complicated. I'm going to do my best to break it down as easy as possible. And in fact, I've come up with what I call my 5 concepts. And I think if we all understand these 5 concepts, then we will better understand what the IRS is doing in this area and hopefully make it a little more clear. Now, the first concept that I want to go over is that during your lifetime, you have the opportunity to fill out a beneficiary designation form with the institution that holds your retirement account. Now, again, that could be a bank, it could be your employer, it could be a brokerage firm. They all have forms. And I want to clarify something. I prefer the written forms. It is possible to do this online. However, most of my clients I find have, once we plan, have more complexity than they can fit in on an online fill in the blank. So a lot of times we ask our clients to obtain the forms for us so that we can help them fill them out. In fact, we create an attachment to the forms so that we can simply staple to our clients' beneficiary designation forms what exactly our clients want to happen, and we simply write "see attached" on the actual form. Now, with this in mind, you again obtain these beneficiary designation forms. When we complete these beneficiary designation forms, they are a contract to pay on death. That sometimes is referred to as a POD, payable on death, or a TOD, time of death. And the good news is that because this is a contract for the institution to do something with your retirement account, there is no probate. So filling out beneficiary designation forms is a probate avoidance tool. The next point I want to make is that you can change these beneficiary designations anytime you want. The latest version that you file with your institution that holds your retirement account is the one that controls what happens at death. And this may be, this third subpoint, one of the most important points today, because many of our clients and the public have a misunderstanding. And let me clarify, it is these beneficiary designation forms which control what happens to these retirement accounts. If you do a will and you do a trust, they have no effect on these retirement accounts. You must fill out this form. So what I mean by that is that you may have a trust that says I leave everything to my children, but you fill out a beneficiary designation form that says I leave everything to my brother. Well, the beneficiary designation form is so powerful, it supersedes your will or your trust, and that money would go to your brother because, again, this is a contract to pay on death. So these are very powerful and really important forms. The second concept that I want to go over is that after you've passed away, the designated beneficiary, again, that's the one who is named on your beneficiary designation form, can continue to defer income tax on the money that you leave them until the money is actually withdrawn. So it's still tax deferred until the money comes out. And that is an important concept. Because the third concept is that the IRS, of course, still wants their share of this money, and they're going to require our named beneficiary, the one who inherited it, to withdraw the money from the account in some manner, in some time period, so that they can collect their tax. As I mentioned, the IRS does have a mortgage on these accounts. Now, although we're going to talk about this a little bit more in a few minutes, but from a tax standpoint, it is preferred that our beneficiaries not do what we call a lump sum distribution, meaning that they take all the money out a few days after you've passed away. And again, I'm going to talk about that more in just a minute. But the concept here is that if they pull the money out shortly after you passed away, they lose what opportunity they have to continue to defer the taxation on this and all the growth that might occur. And they may end up paying the highest possible taxes because we're going to lump all of the income from this retirement account into a single tax year. So this can be a very bad situation. And again, we'll talk about that more in just a second. Now, the fifth concept is that generally the strategy is then to allow our beneficiaries to have the longest period possible to withdraw the money after you've passed away. That way they can defer the taxes and so forth. Now, before the Secure Act, we could do something we call stretching, and we could literally create decades upon decades of tax deferred growth using this stretching technique. Unfortunately, the stretch is dead, and that is the answer to one of our initial questions. Starting basically in 2020, the Secure Act eliminated the ability to do a stretch. And basically, the Secure Act requires almost all of our beneficiaries, and with some exception, which I'll talk about in a second, to empty your retirement account after you've passed away within a 10-year period. So our new rule that we're really dealing with is this 10-year rule. Now, the good news is there are some exceptions to this 10-year rule, and the IRS calls these exceptions for certain individuals. They are called EDBs, or eligible designated beneficiaries. I'm just going to call them super beneficiaries. They have a special status and they can bypass the 10-year rule. So who are these super beneficiaries? Well, a surviving spouse is one of them. They don't have to worry about the 10-year rule. A child that has not reached age of majority, which the IRS says is age 21, can avoid the 10-year rule before age 21. A disabled or chronically ill individual, if you want to name them as a beneficiary, they can bypass or not be susceptible to the 10-year rule. And an individual who is not more than 10 years younger is also another individual in which we don't have to worry about the 10-year rule, but everybody else, adult children, adult grandchildren, individuals, friends, they're all subject to this 10-year rule. Now, the IRS final regulations that came out last year clarified some things and, quite frankly, made it more complicated than we ever could imagine. So, again, if we are not one of these super beneficiaries, the people we leave our money to are going to be subject to the 10-year rule. But where the IRS made things very confusing has to do with the owner of the account and when the age of the owner when they died. So let me tell you the first rule. If you pass away and you are not 73 years old and you haven't started your RMDs, the beneficiaries of your account get to take over your account. They are subject to the 10-year rule, and they can do anything they want for that 10 years. Kind of like what we expected. If you want to take it all out in year 1, or you want to take out some in year 5 and year 7, keep it all into the 10th year. It's a free-for-all as long as the account is emptied at the end of 10 years. And this rule applies to if you are under the age of 73 when you passed away. Now, where the IRS got things really complicated was what happens if you've already started your RMDs. Again, you as the owner of the account, and you pass away and our beneficiaries take over this account. Well, against the objection of almost everyone, the IRS created a rule that said that, yes, you have the 10-year rules, but because the owner had already started the required minimum distributions, you as the beneficiary have to use your own life expectancy over that 10-year period and make RMDs every year for the 10 years that you own the account, with the caveat that it has to be emptied by the 10th year. Now, everyone said, please don't do this. This is going to be so complicated. No one understood it. In fact, even though this rule was proposed years ago, no one understood it and couldn't believe that the IRS would make it this complicated. So they actually created a notice in 2024, which gave relief to everybody who made mistakes in this and didn't do this additional required minimum distribution every year during that 10-year period, and said, we're going to let everyone have a freebie on this. But starting this year, we do have to pay attention to these rules. And if we inherit a retirement account and somebody is 73, we now have 2 rules to contend with. Again, empty it in 10 years and calculate RMDs every year during that 10-year rule. So pretty crazy. So with all these concepts and rules in mind, the choosing beneficiaries for these retirement accounts and filling out this beneficiary designation form is really important, because whoever we list on there is going to dictate how these accounts are treated. So what I've done is I've taken what I'm going to say are my 5 categories or 5 options for beneficiaries for these retirement accounts. And those categories who, again, where we are filling out this beneficiary designation form, could be listing a spouse, listing children, grandchildren, or other adults. Maybe we could use a trust as a beneficiary. Maybe we could list a charity, or maybe there's some combination of all of those. And what I'm going to do now for a few minutes is go through each of these categories and tell you the advantages and disadvantages of each of these categories of beneficiaries. The first category I want to talk about is for those of us who are married. We can name a spouse on our beneficiary designation form and list the spouse. Now, the benefits, of course, is if we pass away, our spouse immediately gets the money available to them. Because they are one of those eligible designated beneficiaries, super beneficiaries, they are not subject to the 10-year rule, so that's great. And unlike any other beneficiary, a spouse has a special rule, which we call the spousal rollover rule, which is really popular among many people who are married because it has an interesting benefit. So I'm going to give you a little example of how the spousal rollover works. If you have an IRA account and you've passed away, and we've named our spouse as a primary beneficiary using that beneficiary designation form, our spouse could open up a brand new IRA and move your IRA into his or her or the surviving spouse's IRA. And that new IRA is treated as if it was the spouse's from the very beginning, the surviving spouse's. What does that mean? That if the new spouse is not 73, there's no required minimum distributions. The new spouse can fill out a new beneficiary designation form, perhaps picking younger new beneficiaries down below on the account. So when they pass away, we can continue to pass this account down. And in addition, about 5 years ago, the Supreme Court said that a spouse who does this transaction and does what we call a spousal rollover can have some extra creditor benefits. So in this situation, there are a lot of benefits to look at doing a spousal rollover. Now, does this work for everyone? Well, maybe not. Perhaps we don't want to let our spouse have full control of all of the retirement accounts. Maybe we're worried about spending other items, so that might not work. Maybe we have a blended family and we're not comfortable having our surviving spouse be able to change beneficiaries on the new accounts. So leaving it outright to a spouse doesn't fit every situation. The second category of beneficiaries that I want to address is perhaps naming children, grandchildren, or other adults as beneficiaries on these retirement accounts. The first point I want to make about naming children or grandchildren is that minor beneficiaries are exempt from the 10-year rule, but it is a little bit more complicated than that. And what I mean by that is that they're exempt from the 10-year rule until they turn 21, and then they are subject to the 10-year rule. So it isn't a complete panacea. But as we'll talk about in a minute, naming young children as outright beneficiaries is a no-go. We don't want to name minor beneficiaries or minor children, grandchildren as beneficiaries because it's going to cause a number of problems, and I'll discuss that in a minute. Now, as far as naming adult beneficiaries, perhaps adult children or grandchildren on our beneficiary designation form, that's perfectly fine. We do have, they are subject to the 10-year rule, so there are potentially many years of tax deferred growth. Again, a decade's worth, so it's not nothing. And perhaps during that 10 years, our recipient beneficiary can manage the tax brackets. Maybe one year they aren't working when they have low income or other situations, and we can try to manage that tax bracket during that 10-year period to make the overall tax as effective or as low as possible. Now, what are the disadvantages of naming children or grandchildren on these beneficiary designation forms? Well, if a child is named as an outright beneficiary, the first is, as I just previously mentioned, we don't want to name a child who or a individual who is a minor. And under California law, a minor is anyone under the age of 18 years old, and those minors don't have signatures. So I understand that people want to maybe name their grandchild as a beneficiary of their IRA, but a 7-year-old can't walk into Charles Schwab or Merrill Lynch and open up a new account to inherit the IRA. So it's a problem, and what ends up happening if we do have minors listed as beneficiaries is we have to open up a court guardianship and have an adult appointed so that they can sign on behalf of the minor. It is something that we would want to avoid. Now, the real issue is by naming adult children or grandchildren or other individuals is that we can, if we give them full control, they may decide to do a lump sum distribution. As we've talked about, Peter and I, this is sometimes happens pretty frequently. And what ends up happening is that this money oftentimes is the first money that becomes available to, let's say, your children. The trust may take many months to finally distribute the money, but with a death certificate and a driver's license, probably within about 10 days of your passing, a beneficiary, for example, a child could walk into a brokerage firm and withdraw your complete IRA. And obviously, we always kind of make a joke. We had no idea that that red sports car had to be purchased, or you had to have your child had to have a remodeled kitchen so shortly after your passing. But it happens all the time. Do you want to throw in anything here, Pete?
Um, no, Mike, it's just so common that the stretch is there even for 10 years is so awesome. I always recommend highly that the beneficiary of an IRA account see their CPA or accountant before they withdraw, because this money's when they withdraw gets added to their regular income for that year, and they will have to pay taxes on it. And I've seen the IRA accounts almost 50% go to taxes, and it didn't need to be that way. And the owner of the IRA was trying to minimize their requirement in the distribution during their lifetime, and all of a sudden they die and the beneficiaries just take the money out. So if you have an IRA account, please do a little bit of planning.
Yeah. We always try to the extent we can to work with our clients' children and grandchildren so that they understand what the strategy is here, and try to make this as tax efficient as possible. Other disadvantages that we can have is that, again, we could have irresponsible spending, but we could also have creditors who are after our children. Maybe there's bankruptcies and other things, and we want to be cognizant of that if we're leaving it to a beneficiary who might have creditors after them. So with that in mind, I'm moving to the third category, and that is, what about naming a trust as a beneficiary? The IRS tells us, yes, we can use a trust as a beneficiary, but it must meet certain IRS requirements, including new requirements under the regulations that just came out last year. And so we have to have a carefully drafted trust to make sure that it meets the qualifications to be a beneficiary on a retirement account. Now, if we are in that situation and we do want to use a trust, it does solve a number of problems. This issue about having control over it is solved because we would name a trustee to be in control of that account, and that means that they would also be in control of the withdrawals from the IRA account. Also, by using a trust, we can protect these assets from creditors, the irresponsible spending, and other things. And if a trust is drafted properly under the Secure Act, we can even create trusts and take advantage of our special beneficiaries like disabled beneficiaries, spouses, and those kinds of things, minor beneficiaries in particular. So there's a lot of benefits here that we can do using a trust. Having said that, as Natalie Choate, who's one of our national authorities in this area, who wrote this somewhat famous book in our area called Life and Death Planning of Retirement Benefits, she says you better have a compelling reason to use a trust. And maybe there is a compelling reason. We have minor beneficiaries, we have a very large IRA account, we have substance abuse. So there can be real reasons why we want to go down this road, but there are some drawbacks to using a trust. The first is, although we can provide for spouses, we can't do the spousal rollover because a trust is not a spouse. As I've already mentioned, the trust has to be carefully drafted under the new Secure Act rules. And we might be prepared to have to pay higher income taxes on on this strategy, because oftentimes money may stay in the trust and pay a higher tax rate. The other disadvantages are that this can be very administratively complex. I kind of joke that if you walk into Fidelity or Merrill Lynch and say that you're the trustee of a trust and you're going to own an inherited IRA account, your representative's head might spin around because it is complicated and it can be very expensive. So keep in mind, if we are going to use a trust, there are some disadvantages. Now, the fourth category, perhaps my favorite category, is naming a charity as a beneficiary. Remember, charities don't pay income taxes, and so there is a great benefit by using our retirement accounts to satisfy some of our charitable goals here. And more specifically, I want to say I often have new clients who come into the office and we have this, what I call reversed, meaning that we have our trust providing for our charities, and I have the clients may have their retirement accounts providing for their individual beneficiaries, maybe their children or grandchildren. And that's just backwards, right? Because we can reverse that and we can use charitable gifting out of the retirement account. Again, the charities don't pay any taxes. We give them what I call the bad money. And then that leaves more money in the trust to provide with what I'm going to call the good money for our regular beneficiaries. So keep this in mind when you're doing your planning, that we want to make sure we maximize the taxes. And Pete, didn't you say you just had an example of this?
Where, oh yes, the individual had $300,000 charity, and he did exactly that. He named individuals as beneficiaries on his IRA account, and the charities he put into his living trust. And so we got that changed because he didn't realize that the charities don't have to pay income taxes. And so this is a great. I even spent uh, my first part of my career at nonprofits, and I would say 95% of the estate plans that I looked at would name the charities in the living trust versus the IRA accounts.
Great. Now, the last slide regarding beneficiaries I just want to make it clear, it's not one or the other. You could take a large IRA and break it up, or have a large IRA and have multiple beneficiaries, perhaps some percentage going to charities, some percentage going to a trust for grandchildren, some percentage going to individuals. So lots of opportunity here to make choices for these beneficiary designation forms. Now, this next slide is about, now that we're under this new tax law, the Secure Act, and we're not able to do this stretching, what about this sort of 10-year rule, and what do we do about it? Since that is the current law and we are susceptible to that law. The first point is that in responding to this, as I've already mentioned, we can manage the tax brackets. We don't have to pull it all out in 1 year, and we can come up with a plan to come up with the most tax efficient way to withdraw the money over that 10-year period. There is also the possibility, if we really do want to stretch this over a longer period of time, to create something called a charitable remainder trust. And in that case, we can fulfill not only getting an income stream to our beneficiaries, but also some charitable goals. I've had some clients, in responding to the Secure Act, talk about possibly buying additional life insurance to help pay the, I suppose, unexpected and higher taxes that are going to be paid over this 10-year period. There's another strategy to respond to this by doing some Roth conversions, and I'm going to talk about the Roth conversions in just a few minutes. One way to respond to this is consider just what we talked about. If you're charitably inclined, why not name a charity as a beneficiary? Then we don't have to worry about all the stretching and the taxes, because charities don't pay taxes. And don't forget that by doing the qualified charitable distributions during your lifetime, or even looking at a charitable gift annuity and lowering the balances of those retirement accounts, is also a strategy that can help deal with the higher taxes that we expect after you pass away. And although this is sacrilege, another way to do it is maybe you go on a cruise and just spend the money, and then we don't have to worry about the taxes.
I love that comment, Michael. What an idea. But it's hard, when you've been saving for your entire life, 40, 50 years saving, and some people have a hard time spending it, but we should encourage it. They're the ones who saved it.
Well, and I think both of our experiences is, though you may spend your lifetime doing all you can to take the very least out of these accounts, and
Yes.
then 10 days after you've passed away, the account is emptied out. So keep that
Yes.
in mind. All right, this next slide is one of my favorite slides of the presentation this morning, and that is, these are the mistakes I've seen on beneficiary designation forms for new clients who come to see me, and I'm helping them try to solve these problems. So the first mistake I see in my practice, unfortunately, is the blank beneficiary designation form. Please don't make the mistake and leave it blank. I have had a number of cases like this where somebody comes in, and maybe it's the surviving children, and nobody filled out a beneficiary designation form on their $1 million IRA. It's a problem, and what it means is we're going to have to go to court, and it likely means a probate. Another mistake I see, is probably with the best intentions, is somebody writes in the words "my estate" as a beneficiary designation. And unfortunately, that doesn't have any legal consequence. It's as if you left it blank. I think people think maybe it means find my closest relatives, but what it really means is we're going to have to open up a probate. The third point we've already talked about, we don't want to name minor beneficiaries. I know that everyone has the best intentions in naming a young grandchild and so forth, but it's going to cause a real big problem, namely a guardianship. The fourth point is we want to make sure that when we fill out this beneficiary designation form, that we fill out both the primary and contingent sections. And you'll see on those forms, there's a section to have our first beneficiaries and then backup beneficiaries. The reason this is important is that unfortunately, sometimes life doesn't always go as planned, and perhaps we've lost our primary beneficiary. We want to have backups. Or there's another reason to think about it is that we can do something we call post-mortem estate planning. And what I mean by that is that maybe our primary beneficiary has survived, but there are reasons why the primary beneficiary doesn't want to receive the money. Maybe creditors, or maybe they have too much money already. Maybe we want to use our contingent beneficiaries and our primary beneficiary may disclaim. But we can't do any of that planning unless we put a lot of thought into the beneficiary designation forms and filled out both sections, the primary and the contingent. The next point is not keeping beneficiary designations up to date. This happens all the time. I'll have a new client sit down with me and we'll find that his or her beneficiary designations has a spouse from 2 marriages ago listed as a beneficiary. So we do want to make sure that these keep up to date with changes. The second to last point is not keeping records of these beneficiary designations. There's been a lot of bank mergers and acquisitions, and these forms have been lost. And I have had cases where it's a he said, she said. The institution says we don't have a form. So what we do with our clients is once we've completed the forms, we have our clients submit it, and then we want them to get a letter back in the mail, a written confirmation saying that the institution has received their beneficiary designation, it's on form or on file, and we have them keep those confirmation letters in their estate planning document. So after you guys are gone, if there's some question about whether you submitted the form, we know that that is on file. And that's the other thing that sometimes makes me nervous about using the online option here is, if you don't get a written confirmation, I don't know how you prove that you filled out the section online. And the last point or mistake that I want to talk about is not considering or planning for, as we have talked about, the income tax issues associated with all of these accounts. With that, we are going to turn to the last section of the presentation, and those are Roth IRA accounts. Now, all morning, we've been talking about regular retirement accounts, but here's the interesting part. If you have a Roth account, they have a different set of rules. And the first rule I want to talk about is there are no required minimum distributions during your lifetime. So all that stuff about uniform tables and calculating RMDs, it doesn't apply to your Roth account. Also, you can continue to make contributions to these Roth accounts as long as you have earned income. And so that's kind of a nice feature. But the real feature of these Roth accounts is the tax-free growth. Remember, these accounts are really tax-free, not like the other retirement accounts where they're tax deferred and someone has to pay the taxes. These accounts are truly tax-free. That means that they're tax-free distributions to you in the future, as well as your beneficiaries in the future. Now, these accounts, once you pass away, they can be left to beneficiaries just like our other accounts. They do put the 10-year rule on them, so you can't stretch them for more than 10 years. But having said that, again, there's no tax when we pull money out of these accounts. And we can do that spousal rollover with these Roth accounts. So if we leave a Roth account to a surviving spouse, that spouse can roll it over and treat it just like it was their own account and not have to worry about the 10-year rule, etc. So some pretty nice benefits for these Roth accounts. Now, you might be saying to yourself, well, I don't want my old retirement account. I want to get one of these fancy Roth accounts. And the truth is, you can do it. You can convert your existing retirement or traditional IRA accounts into a Roth account, and we call that a Roth conversion. Now, everyone is eligible to do this kind of Roth conversion. In prior iterations of the law, there were some income limitations and other things that has all been eliminated because the IRS wants you to do this because this is the catch here, everybody. You got to pay the tax on the Roth conversion. And I'll explain more about that in a second. But the bottom line is that in the year you do the Roth conversion, you have to pay the tax on the conversion. So with this in mind, this can be very expensive and needs to be carefully planned. And I'm going to go over some factors that we can consider in doing some analysis on whether it makes sense to do a Roth conversion. And one point before we look at those factors is that there are no more recharacterizations. Back in 2018, they changed the law. Prior to that, you could do a Roth conversion, and if you didn't like the results, you could reverse it. Well, they took that away. If you pull the trigger on this Roth conversion, there's no going back. We can't restore it back to the way it was. So again, we have to think through this carefully. So here are some factors that are worth contemplating on doing a Roth conversion. One of the factors might be that if you expect your income tax rate to be higher in retirement, maybe it makes sense to do some Roth conversions now at what will ostensibly be the lower tax rate. Another factor is that you don't think you're going to need this money for living expenses, right? We don't want to convert this account, pay the taxes, and then have you start to immediately need to withdraw the money from these Roth accounts. And that works in tandem with the next point. We want to make sure that if you're going to do a Roth conversion, that you have a time horizon long enough to make this tax-free growth in these retirement Roth account worth our while. The second to last point is that you have to be able to afford to pay the taxes on these conversion using separate funds. And what I mean by that is that we don't want to use the IRA accounts themselves to pay the taxes. So let's say we're going to do a $100,000 Roth conversion. We're going to take our traditional IRA and convert it to a Roth. And I'm going to say, let's say there's a $30,000 tax bill to do this conversion. We don't want to end up with $70,000 in a new Roth account because we use 30 of our IRA to pay the taxes. What we want is $100,000 going into the new Roth account, and then for you to use other money in your brokerage account, in your bank or savings account to pay the taxes so that we can maximize this. This is important because if we can't afford to pay the taxes in separate funds, the math doesn't work out so well. And there are, last point, some estate planning objectives to consider when doing this. Now, the good news is that you may be able to rely on your financial advisor or CPA, who often have software which can run some calculations on this and determine what makes sense and whether a Roth conversion is going to be a good strategy for you. The last slide that I want to talk about is just an idea about perhaps jumpstarting your child or grandchild's retirement account. If you have a child or a grandchild and maybe they're working at, I don't know, Jersey Mike's and they earn $7,000 a year. Well, if they do that, you can put in $7,000 into a Roth account. It doesn't have to be the same $7,000. They do have to have the earned income, but you could gift the $7,000. Now think about that. Let's say we're starting for a 15-year-old or a 16-year-old, and you start putting 7,000 or more into these accounts over the years. We could make our child or grandchild with tax-free growth millionaires in these Roth accounts. And the good news is, of course, when they're 59 and a half, all of the tax-free growth, they get tax-free withdrawals. If they needed to access the money before 59 and a half, there's no taxes or penalties until all the contributions are withdrawn. There's special tax breaks if we have to pull the money out earlier for college and first-time home purchases. And under the Secure Act 2.0, another interesting way to jumpstart our kids' Roth accounts is that if we have unused 529 plans money, college savings money, we can move up to $35,000 of those unused 529 plans into a Roth account. But do keep in mind that our child or grandchild who we're setting these accounts up will have control of these accounts when they turn 18. And even though you intended to make them millionaires, they decided they needed a new car instead when they were 19 years old. So we have to factor that in too. So today we've really focused on retirement accounts, but that's just one component of a full estate plan. And I hope after today's presentation, you see how that fits together in your one unified estate plan and one successful estate plan. And with that, that's the end of my prepared remarks. I'll stop sharing my screen. And as Pete mentioned, I'm not billing, so feel free, ask as many questions as you like.
We've got a question. Don, you want to come on the screen as well? Do you want me to read it? Let me read.
You can read it.
Okay. What is the required information needed for beneficiaries besides their names, social security number, contact info before meeting for a consultation? What materials should one bring?
So we have something we call an estate planning questionnaire. And if you contact my office or if you even look on the website, the first page has a listing of all the things that we request new clients to bring to our meetings. And then that follows with a form that collects all the necessary information uh, specifically about listing about assets and so forth. And I realize filling out a form isn't really any fun, but the form is important because it allows me to look at your situation, do some analysis, and filling out this form creates what I think you're learning about, a really nice inventory roadmap for our beneficiaries of everything that you own with all of the account numbers, etc. So that again is everything that you're going to need to start out with.
There was a question in the chat regarding why should one want a letter from the financial institution listing the beneficiaries versus just looking online and copying that and putting it with your file?
Um, the difference is that when we need to access that information, it may not be available. And I actually had that situation where we had no written confirmation of a named beneficiary, and the institution then also blocked our access to see anything online or access the account at all, and simply took the position that there was no beneficiary form on file. So the ultimate would be if we had a written letter from them, a printout of the screen, maybe it's going to help, but man, generally having this letter is better. And more importantly, they generally issue these letters immediately. As soon as you file one, most institutions will automatically generate this letter. And if you don't have the letter, just call the 800 number, they'll press a button, and a letter will come in the mail.
Yeah, and there are so many financial institutions that have been merged or have been bought, and so just having that letter is just security. And remember, the IRA accounts account for how much money did you say? 43 trillion?
That's right.
Yeah, it's just mind-boggling.
Do
Um,
I need to know the social security number of my beneficiaries?
The answer is yes. Most institutions have a section and they are going to want the social security number, birth date, and address of your beneficiary.
Uh, Don, do you want to mention, or well, like we can mention it, it's that if somebody wants to orally ask a question, all they need to do is click on the raise your hand. Is that correct,
I'd love to
Don?
have them type it into the chat or the
Okay,
Q&A. Make it a
okay,
lot easier.
all righty. There is a question in the chat. Is there are it seems like there are some different consideration rules for IRAs versus 401k. How does one learn more about these?
Well, let me first say, I guess, as to the point about learning, you're really going to have to rely on your professionals, your CPA and your financial advisor and your attorney. But I can say, and was often a point I like to make, is that there is a big difference between the 401k plans and 403bs. Those are all covered by a federal law called ERISA, which is different than the rules that govern IRAs. And the reason this is a big important distinction is that the ones that are covered by ERISA can have their own rules that may not align with all the rules that I talked about today. So what I'm saying is that if you are in a 401k at your company, they may restrict what our beneficiaries can do with their retirement accounts after you pass away. So many times clients want to leave their retirement accounts, their 401ks, et cetera, and move to an IRA because it provides them greater flexibility. There is some benefit under the ERISA plans if you're worried about creditors, but for most of our clients, they like to roll out of those 401k plans, get the flexibility, get a larger investment horizon, and be susceptible or have the ability to take advantage of all the rules I talked about today.
Yeah.
Michael, there's a question that if I we're married, my spouse earns all the money, I earn no money, am I allowed to open up a Roth because we have earned income on a joint tax return?
Yeah, I'm not the CPA, but I believe the answer is that spouse's income will qualify you to make a Roth contribution.
And is there a max AGI, adjusted gross income level
And because I get that question every time, I've got the sheet right here in front of me, and here they are. A single head of household for 2025, 79,000 to 89,000. Again, these are the phase out numbers where you can make contributions to a Roth.
that was
Married,
head of household. Is there married filed jointly?
yeah, married filed jointly is to 126,000 to 146,000, and then there's married jointly and some other provisions, but those are the two main ones. And for people who exceed those numbers, you can Google backdoor Roth and see if that's something that might be of interest to you.
This
Okay.
is not an area where you want to do it yourself. I mean,
No,
I want to
no.
kind of echo Michael's advice. Get an advisor. There's a lot of money involved and a lot of taxes. So um, you need some expertise in this area. Michael, let's say if I have a inherited IRA, I have a rollover IRA, I have a spousal IRA, I have a 403 rollover IRA. Can I combine these to make my life a little simpler?
I wish you could, but the answer is no, because many of those ones that you just listed have a different distribution schedule, so the IRS doesn't allow you to combine them.
But each one of these IRA accounts, I can, all the rules that we had talked about, once they're in an IRA, are the same rules.
Well, under each category. So your IRAs follow a certain set of rules, inherited IRAs follow a certain set of rules.
So the more IRAs you have, the more complicated it becomes. Why
That's
should
right.
why should someone roll over an IRA if they have a 403B or a 401k or a 457 plan? Why should they even consider rolling it over? Wouldn't it just be simpler just to keep the account that they have?
Well, as I mentioned, there are some advantages to rolling over, namely, again, from an employer type plan to an IRA. You might want a larger investment horizon. You might want consolidation of accounts, but you also want the flexibility to be able to take advantage of all these rules, which may not be available in an employer sponsored plan.
Yeah, 401k would not allow the beneficiaries, for example, to do a 10-year stretch.
Well, the
Those,
answer is
those are off.
maybe.
Also, it depends on the
It,
plan
it
also.
just depends on the plan document.
Yeah,
That's the
but
that's the risk. Yeah.
most plans, I would say
Yeah,
90% of the
yeah,
plans would not allow you to do it.
right. Yeah.
But but I like the attorney answer that it depends.
Well, and the other part of it is if you have multiple IRA accounts, because and Michael, correct me if I'm wrong, I can pay all of my minimum distribution out of one of the accounts.
That's correct. But we can't do that among between inherited IRA accounts and regular IRA accounts. But for
Okay.
regular IRA accounts, yes, we can combine them all and take advantage of the rule that I mentioned.
So then what
What
you
a,
do is you take the one that has the lowest balance, pay it out of that one, and therefore you got rid of one of the accounts earlier, and you move over to and keep going on the
you
other ones. That's how you consolidate them.
Yeah. Well, the key is you want to make your life as simple as possible as we get older. Annuities. Are annuities similar to IRA accounts?
They are those annuities. The part that is the growth is what we call IRD, or income respect of a decedent, is subject to taxation. There are so many different kinds of annuities. We have to look at the annuity policy itself to determine what the rules are, but they can have minimum distributions and can be subject to taxation.
Yeah. Annuities, commercial annuities are not favorable vehicles to give to heirs because just like an IRA account, whoever receives or the beneficiary of annuities will have to pay the income taxes when they withdraw. And so, let's see, we got another question. If we will be 73 after 2023, should they anticipate that they will fall into the RMD
After
rule
2020,
at
after
75?
2033?
Yeah, I think there's a correction. They meant if I'm going to be 75 after 2033, should I expect the rule to be 75? And that's correct. The rule, as written under Secure 2.0, says that in 2033 the age will be 75. But I believe there's an interim step to age 74 in the next number of years, so we have to factor that into.
Yeah, if I have an inherited IRA, can I make tax-free charitable gifts from that inherited IRA?
I don't believe so.
I
I'm
thought you
gonna
could.
refer you to CPA on that one, but
It
I'm not
depends.
sure. What's that?
It
It,
depends.
I think you can, but I'm not 100% sure either. So, but I thought you could because it was kind of like your own, but I'm not 100% for sure.
It
Somebody
is
could
now
do a
11, it is now past 11:30, so I'm going to declare that we have now finished. And so I'm going to stop the recording. This has been it's your it's your state. I gotta remember what day it is. It's your estate. We've been talking about retirement accounts. Thank you, Michael. Thank you, Peter. And I'm going to stop the recording.